Hi, my name is Adam, and today we're going to be talking about T accounts. You may be saying, Adam, what's a T account? I'm not sure what that means. I'm glad you asked. We're going to cover that within the next couple slides. Real quick, why do you need a T account? Before we get too deep into it, just Adam, why do I need to know what this means? So T accounts are a really simple way of annotating the money that goes in and out of an account. And as someone, maybe you work with finances in your business, maybe you're an entrepreneur, maybe you just want to get your own finances at home, right? T accounts are a very simple way to go and track where the money is. Now, T accounts are going to start off looking really simple. Then, as we get a little bit more advanced, it may look really complicated. Um, don't worry, don't fret. It's going to be okay. It's going to make sense eventually. As we get further on down the line with more advanced practices within accounting, we're going to talk about double entry accounting, and you'll see why this is very important and how it can get kind of confusing, but how it's absolutely necessary to track where your money is. James Vanderbeek is not happy. Mr. Dawson's Creek is upset because his books are not balanced, and that's a huge issue when we're getting into finances. A has to equal L plus E, so assets have to equal liability plus equity. We need to make sure that everything matches up and everything is equal, and T accounts help us get there. Before we get too in depth with T accounts, let's just cover a basic definition of what is an account. An account is simply a record of all the changes to a specific asset, liability, or equity item. You can think of it like a notepad, if you will. Each accounting item has its own notepad that's used to document all the increases and decreases to that item over time. And again, we'll get into that later with more advanced topics, but just basically, this is what an account is. All right, now that we have the basic definition of an account out of the way, let's talk about T accounts. As you can see here, T accounts are simply a method of documenting an account in the format that is in the shape of the letter T. It looks kind of like this. As you can see here, debits go on the left and credits go on the right. Now I want you to remember that. Debits go on the left, credits on the right. Now sometimes we get confused here. So a lot of times we think of debits as taking money out and credits as adding money to. That's a misnomer here, okay? I want you to kind of break that habit out of your head. It's just a different way of annotating on this T account. Debits always go on the left and credits go on the right. Depending on what type of account we have, is what kind of account it'll be. So we have debit accounts and we have credit accounts, and as we move forward, it'll make more sense. But please remember, debits go on the left and credits go on the right. So we just said that depending on the type of account is how we annotate whether it's debit or a credit account. And you can see in this slide how that's so. So if it's an asset account, if it's a debit, you go and you increase it, right? It'll be on the left-hand side. And credit goes down. Now, if it's a liability account, debit goes down and credit goes up. And so same follows for equity. It's going to seem really confusing really quickly. The T account concept is easy, but then we get into here and it's going to get a little weird. Hold on tight. It's going to be all right. Um, just make sure you keep this handy. Again, assets, debit goes up, credit goes down, and liabilities and equity will be the inverse of that. We're looking here at common asset accounts. And quite simply, these are things that the company has that are assets to it that they're going to use for future value. Obviously, cash, they're going to use it to buy things. Accounts receivable, that's money that's going to be coming into the business. Notes receivable, same thing. Prepaid expenses, these are expenses that have already been paid for, they're taken care of. Land, again, that'll be used in the future and is being used. Same for building and furniture. Now, all these have a debit balance and represent the resources a company has at its disposal. Pretty cut and dry. Remember that when it's a debit balance, go back to that last slide. A equals L plus E, so assets. What kind of balance does that have? A debit balance. This is a great example of a T account for a cash, right? So it's an asset for us. Left side is what? Debit, and right side is credit. You're exactly right. So on the left side, capital introduced, that's money coming into the business, is $2,000. So somebody put $2,000 into the cash account for this business. They've made $3,000 in sales, and then also $100 in sales. Fantastic. On the right hand side, we see credits, right? So that's money that's being taken out. We have $200 that is paid in wages, $1,400 in purchases, $200 in rent, $100 for heating, and the closing balance is $3,200. Below that, you can see the $5,100 on both sides. So the balance is $3,200. Seems pretty simple, right? It's because it is. Again, on the left-hand side, we have our debits. Right-hand side, we have our credits. And for a cash account, which is an asset account, debits go up and credits go down. We're looking here at common liability accounts. And a great way to just remember this, liability accounts are accounts that money is leaving the business. It's money that we owe to people. Such examples are accounts payable, notes payable, taxes payable, salaries payable, and unearned revenue. Again, this money is leaving the business, and as much as we don't like to see that, it's a must. Now, opposite to our asset accounts, the debit is going to go down on this one because it's a liability account, right? And the credit is going to go up. All right, finally, we're looking at our common equity accounts, and these include owner capital, owner withdrawals, revenues, and expenses. These go and show the owner's stake in the company is essentially what it comes down to. They have a credit balance. So again, just following like our liabilities accounts, um, debit is going to take this down, and credit is going to take it up. I hope this covered just the basics of T accounts, and I hope it gave you a little bit of clarification as to what they are and how we're going to use them here in the future. I'm looking forward to going adventuring with you from here on out to show you some further accounting principles and how we can apply them. This verse is very pertinent, I think, to accounting as a whole. 1 Corinthians 4:2 reads, "Moreover, it is required of stewards that they be found trustworthy." Uh, A has to equal L plus E. Assets have to equal liabilities plus equity. It's our job to make sure that the books are balanced and we're doing our best for ourselves, for the company, and to honor God. Thank you.